Welcome to the deep dive. Today we're digging into Karnataka Bank's financial year 2025 performance.
Yeah, we're using their official investor presentation, the audited results they share with analysts.
Exactly. Our mission here is to pull out the key insights for you, the investor. We'll focus on earnings trends and other important financial bits.
Sounds good. Let's get straight into it, comparing FY25 with FY24.
Okay, so first up, deposits and advances both grew. Total deposits hit 1,004,850 crore. That's up 7%.
And gross advances also climbed, about 6.8%, reaching 77,959 crore.
But the interesting part for me is where that growth came from.
Right. You see that retail, agri, and MSME advances together grew by over 10%. And retail term deposits saw similar growth, 10.2%. So it suggests a real strategic focus there.
So like shifting towards those specific segments, maybe for stability or lower funding costs.
Precisely. More retail deposits, less reliance on maybe higher cost bulk ones. Seems like the plan.
Got it. Okay, now profitability. It's a bit more of a mixed picture here.
Yeah, it is.
Return on equity, ROE, dipped from 13.71% down to 11.9%.
And ROA, return on assets, also down slightly, 1.19% to 1.05%, though there's an adjustment there, right?
Yes, exactly. If you adjust for how they account for certain investments, the available for sale reserve, the FY25 ROA looks better, 1.14%.
Which highlights how these accounting changes can affect the headline numbers you see.
Definitely. Net interest income, or NII, that was almost flat, up just more 0.4% to 3,310 crore.
Although they did note a reclassification of penal interest affected that. Without it, NII would have been higher, around 3,371 crore.
Ah, okay. And net profit after tax, PAT, actually down slightly year on year. But again, with that AFS reserve adjustment, it would have been higher than FY24.
So despite loan and deposit growth, those key profit metrics didn't quite keep pace. Suggests maybe some pressure on margins or cost creeping up.
Which brings us to NIM, net interest margin. That definitely saw pressure, down from 3.52% in FY24 to 3.19% in FY25.
And even lower in the last quarter, Q4, at 2.98%.
Yeah, though the adjusted figure for the full year was 3.23%. Still, a noticeable downward trend. That's something investors will watch, for sure.
Absolutely. And they give a reason for that pressure, too, related to how their lending rates are benchmarked.
Right, tied to GSECs and T-bills, which may be moved differently than the repo rate that many other banks use.
Exactly. That linkage apparently put some downward pressure on their margins, especially with market expectations around rates.
Okay, but moving on to some potentially better news, asset quality. Looks like improvement there.
Yes, definitely. Gross NPAs, the bad loans, down from 3.53% to 3.08%.
And net NPAs after provisions also fell, 1.58% down to 1.31%.
That's encouraging. And maybe even more so, the slippage ratio, the new loans turning bad, drops quite a bit, from 2.80% down to 1.71%.
That's a significant drop. Shows better maybe risk management or recovery?
Could be both. Plus, they increased their provision coverage ratio, PCR, to over 81%. So a bigger cushion for potential losses.
Good to see. What about CHIS, current and savings accounts?
Those grew in absolute terms, yeah. Up 6.4% to over 33,000 crore.
But the CSA ratio dipped slightly, 31.94% down to 31.75%.
Meaning other deposit types, likely term deposits, grew a bit faster. Ideally, banks want a high CSA ratio because those deposits are usually lower cost.
Makes sense. And just looking at the last quarter, Q4 FY25, anything stand out?
Well, that strong retail advances growth continued, up over 15% year on year in Q4.
Wow.
And they specifically mentioned reducing high-cost bulk deposits. They're now just 6.6% of total deposits. Reinforces that strategic shift we talked about.
Okay, so the big picture so far, growth, yes. Strategic shift towards retail, yes. Asset quality improving. But profitability margins under pressure.
That sums it up pretty well. Now, let's maybe touch on some of those other factors for the presentation that investors should know.
Like the one-off items?
Yeah, those can really skew the numbers if you don't account for them. Like that penal interest reclassification reducing NII by euro crore.
Right. And on the flip side, that accounting change for investments boosting profit before tax by nearly over your 150 crore.
Plus, things like increased provisions for employee benefits and the impact of the new bipartite settlement on salaries. It's good they call these out.
Gives you a clearer view of the underlying operational performance.
Exactly.
And circling back to that NIM pressure, the bank estimated that their specific benchmark linkage, the GSEC bill thing, cost them about 0.5% on their NIM compared to if they were linked to the repo rate.
Which explains a lot of that compression we saw. It also means, if that rate environment changes or stabilizes, maybe that specific pressure eases off.
Worth watching. The presentation also gives a good breakdown of their loan book over time, right? Showing that shift.
You can see the quarterly trend, retail growing, corporate maybe less so, and sectoral exposure changes too, like in agri, MSME, and BFCs, infrastructure.
Helps you understand the risk profile and where the growth is concentrated.
Absolutely, and they go into even more detail on asset quality.
Like breaking down MPAs by sector and loan size.
Yeah, and the movement additions, reductions through upgrades, recoveries, write-offs, quarterly and annual views, plus updates on the restructured portfolio, which is shrinking.
And SMA2 accounts, the ones showing early stress signs. Keeping an eye on those trends is important too.
All crucial data points for assessing the real health of the loan book.
Then there's the other side of the balance sheet, the liabilities. Deposit profiles, costs.
Right, the mix of term, current, savings deposits, how the cost of deposits and overall cost of funds are trending, that directly hits the bottom line.
And efficiency. Cost to income ratio, business per employee.
Key operational metrics. How well are they managing expenses relative to income? Are they getting more productive? They also show staff cost trends and product per customer.
And of course, the standard key ratios. Capital adequacy.
CRAR, Tier 1, Tier 2, essential for stability. Plus, risk-weighted assets, liquidity coverage ratio, LCR, and credit cost trends.
Okay, so quite comprehensive. What about their transformation journey they keep highlighting?
Yeah, they list key achievements for FY25, framing them as steps towards a more stable position. They've set targets, too, for improving cost of funds, NM, cost to income, ROA, NPAs, CASA swap.
And it all seems tied to that focus on retail, agri, MSME, plus a big push on digital.
Definitely. Mobile apps, net banking, digital factory, analytics. Seems like a core part of their strategy getting forward. Building an outbound sales culture, too.
Okay, so wrapping up the key takeaways for investors, we've seen growth, especially retail-focused. Asset quality is getting better. But profitability, particularly M, faces headwinds partly due to their rate linkages. They're actively shifting strategy, managing costs, and pushing digital.
Which leads us to the final thought for you to consider. Given this clear strategic direction, the focus on specific sectors, the digital transformation efforts, how effectively do you think Karnataka Bank can navigate the ongoing interest rate uncertainties and translate these strategic shifts into sustainable long-term profit growth and market position? What specific milestones or metrics will you track to judge their success?